Okay, welcome everybody to episode 120 of my live stream, and it's been quite a week. We've seen, well, actually continuing from last week, we saw that massive silver crash. I was actually live streaming and taking profit on a nice trade there. And then this week, there's so much going on that I think people didn't quite realize that silver crashed twice. So there's actually right on the anniversary of the February 5th Apocalypse event, and crypto crashed as well. So it's been quite a week. We've had some economic stuff. Of course, we had the Epstein stuff. It is getting very, very difficult to keep track of everything, but we will try to keep our sanity and still try to focus on making good investing decisions. I will be here every week, so of course, subscribe to the channel so you can tune in to the future live streams. I will be doing more videos, so just put out one yesterday, and there will be more next week. So appreciate everybody and all the support. But what we're going to talk about today, I briefly touched on it last week, that I'm going to start talking specifically about the strategic tail risk strategy, because I think it's the one among our strategies that in fact might be the most interesting, because there's a lot of different ways that we could put it together and a bunch of different ETF replacements we can go over. So it's actually pretty interesting. And we'll do that. And then the second thing, we're going to do a chart blitz. I do think that it's appropriate to talk about Bitcoin. You know, not a whole lot of my portfolio is in crypto, basically about 5%. But, you know, with all that's happening, I think it's a pretty interesting subject. And then, of course, the open Q&A, we will get into that as well. So you can start putting your questions in the stream. But let's actually just get right into the first segment. Okay, so like I said, strategic tail risk strategy. And the reason that I want to be talking about this in the live streams is for those of you who may know, you know, VTS members obviously know, but if you tune into my work, you've probably heard reference to it. We do have a course library. So there's articles and videos, and I try to package them all together in a theme and really go over everything in detail. So we've got, you know, individual strategies, Iron Condors here. This is 30 videos. We've got other courses. Volatility trend is UVXY butterflies, stock replacement, of course. But the one that I want to actually start building is an individual course for the strategic tail risk. But of course, they're very time consuming. So I thought what I would do is try to do this live, right? Is try to get as many of them as I can. I've got a good outline for the course here, a lot of interesting subjects to get to. So, you know, maybe a 5-minute segment every week in the live stream. And, you know, 3 or 4 months from now, it's going to be into a really nice course. It'll save me time, and it'll also organize everything for people. So that's what we're essentially going to be doing. And so today, I wanted to start off that process by talking about the strategic tail risk strategy. Why isn't that showing up? Just a second here. Okay. I don't know why this isn't showing up. This is going to actually ruin the entire live stream if this doesn't show. Bear with me here. Technical difficulties. I have no idea why this isn't showing. That is showing. There we go. Sorry about that. Okay, so we're talking about the strategic tail risk strategy today. Now, it's 1/3 of the portfolio. You can see that these are the other strategies. And it's essentially tactical rotation. We're basically allocating to the ETFs that have the best probability of success given the current market. The whole portfolio does really well combined, but strategic tail risk is quite important. And it's actually maybe, like I said, the most interesting, because this is a long short volatility strategy with gold as the safety. It's not entirely written in stone, but I have not made any major changes in basically 20 years or 15 years. And defensive rotation, kind of the same thing. I would be willing to make changes if it was absolutely necessary, but nothing really needs to be adjusted and hasn't been adjusted other than some small changes. But this is the strategy that I allow myself to make changes on. So as far as a live stream and what would be interesting, you don't have to be a VTS member to understand that when we're talking about S&P 500 in stable volatility, this is what we call our aggressive positions. And there's plenty of different ETFs that we could substitute in there to try to see which one is actually the best. So that's what we will be talking about today. And then maybe the more interesting ones are, what do you do during safety, right? Real estate and Coke, depending on interest rates. This is what we're doing based on performance. But perhaps next week we'll talk about a whole slew of replacements. And these are the fun ones, the DBMFs and the tail and swan and all these things. There's a lot of cool funds that we can test. And then, of course, the last one, we use chaos, but there are other choices there as well. And these two are kind of the interesting ones. But we do have to start with the aggressive positions. It's essentially the heart of the strategy, even though what you do during safety and what you do when the market crashes is definitely the most important thing. We are in these positions by far the most. So that's what we will be talking about today. Now, I do want to just super quickly, I have gotten this down to, I believe, less than 2 minutes, but you have to know the underlying fundamentals of the strategy, and then we can get into the replacements for the S&P 500. So I hate to be the bearer of bad news here, but at some point, eventually there's going to be an extended recession. So let me share with you one of several ways that I'll be ready when it finally does, and break down the VTS strategic tail risk strategy. It's a systematic, rules-based strategy that only allocates capital to the asset class with the highest probability of success given the current market environment. And all of the signals are coming directly from my VTS volatility barometer. This is my own design of a comprehensive volatility index that's far more robust than anything else out there because it's a combination of over a dozen key volatility metrics. This chart here is for the last 3 years, and we'll be holding the SPY ETF anytime the barometer is in its mid-range or below. That represents market stability, and long-term, this is where the stock market has its best performance. Now, it has been an extended bull market, so naturally the volatility barometer will be spending a decent amount of time in that aggressive range. But the strategy is designed so that when that's no longer the case, and we're in an extended recession, then those equity positions won't be signaled very often, if at all. Now, the second layer happens in that mid to high volatility barometer range. When it's here, volatility isn't elevated to the point of actually having to short the market yet, but it is a higher risk area, and we definitely can't be taking aggressive positions anymore. This is the consistent performance we're looking for safety positions when it's too risky to be holding the S&P 500. And now I can highlight what makes this a tail risk strategy, because anytime the volatility barometer is in its highest range, signaling extreme danger levels of volatility, we'll be holding the Chaos ETF. Now, Chaos itself isn't a very good buy and hold vehicle because it only performs well when the stock market is crashing. But that's also the only times we'll ever be holding it, so it works really well for us. This is showing just those Chaos positions in the strategy, which have flashed on about 7% of trading days. Pretty great performance for how rarely we actually need to hold this. That's the benefit of the VTS strategic tail risk strategy. Targeted positions that match the current volatility environment. In my humble opinion, buy and hold investing was always dead, but especially these days with bonds having almost no chance to provide investors with any tail risk protection, tactical investing is the only choice left. Okay, so like I was saying, today we do have to talk about the replacements for the S&P 500, the bulk of the strategy. And before we get into the replacements, I do just want to touch on a question that came up last week. Somebody asked me what's the difference between the SPY and the SPY, basically the SPY minis. There really is no difference. This is the long-term matching going back to the launch of SPY M. And you can see, what is this? 0.12% difference. So it's not nothing. I mean, there is a tiny, tiny difference there, but essentially they're quite efficient. This one has slightly lower fees and also lower dollar. This one, of course, the SPY has the most liquidity, but to be honest, they're both massive funds anyway, so that doesn't really matter. To be perfectly honest, I'll probably write something, next week or the week after, basically illustrating that it is a perfectly acceptable substitute. And given that the price is significantly lower, it's probably far more efficient for people with smaller accounts to be trading the SPY M. But you can see they're basically the same. But we're going to be using the SPY because that's what the strategy is based on. Here is what we're actually trying to beat. Now, this is the S&P 500. This is only on about 70% of trading days. Like I said, we will get into what we do on the other ones. But first of all, we just need to touch really quickly, what about the NASDAQ? Now, you can see actually because it uses specific metrics based on the S&P 500, it doesn't actually substitute very well with the NASDAQ index. But even if it did, I wouldn't use it because defensive rotation already uses the NASDAQ anyway. I just thought people might be interested to see that. Same thing here, short volatility, just straight in substitution. Doesn't actually work that well within the metrics for this strategy because you need very specific volatility metrics in order to get the performance out of the SVXY. And again, we already use that in tactical volatility, so this is just for people's interest. But the first thing that we can talk about, the Dow Jones, right? We can go through the basic indexes first. Now, the Dow underperforms the SPY. Same exact signals, just straight up substitution. And this is basically reflecting the fact that the S&P is a little bit more heavy on those big name stocks. It's just a better performer for this strategy. The MDY is the S&P 400 mid-cap ETF. And there was a time, certainly in the past, where this thing worked really well. But of course, in the last 10 years or so, it is those high-flying mega tech stocks that are doing the best, and that's not included in the MDY. So you can see the performance isn't great here. And then the Russell 2000, IWM in this case, again, it actually has periods where it's pretty good and it looks promising, but the drawdowns are too large, and I just simply would not consider using that. So now there's actually a lot of variations on the S&P 500 that these fund managers, obviously they want to make their money, they want to get their fees, but a couple of them are interesting. So SPLV is the low volatility S&P, and right off the bat, you can see the performance kind of sucks, but the drawdown is at least interesting to take a look at, right? I mean, that is pretty low for basically the aggressive position in a strategy. Then we've got the SPHD. This is the high dividend yield S&P 500 stocks, so those ones sort of focused in this ETF. And performance is actually even a little bit better than the low vol with the same drawdown. So now we're getting kind of somewhat interesting. Not anything I would use, but interesting. And just a note, every time that there's a red thing, that just basically shows where it launched officially. And I'm just using the S&P 500 data matching before those dates. So again, here it is here. This is the NOBL. It is a good dividend ETF. And you can see here it's even better than the SPHD. The NOBL, again, not going to use it, but it's certainly interesting, right? I mean, dividend stocks tend to have that dividend yield. People really flock towards dividend stocks for some reason. And so if you focus on those, it's not the end of the world, but certainly not that interesting. SPMO is something I get emailed about quite a bit. So of course I have to include it. Data doesn't go back that far, but it's interesting. This is basically an S&P 500 momentum ETF, actively managed. They're basically taking the 100 stocks that their internal formula deems to have the best momentum. And as we can see, the performance is decent, right? It's going in the right direction, but the drawdowns are too large. So that's a problem. And another thing is I personally don't like when I don't know how they're actually determining what goes into the ETF. Like, what does momentum even mean? I don't know that. And so it is a little bit risky when you're relying on somebody else. You can see if they miss it, it can miss. So, I mean, obviously not worth substituting, just straight up SPY. Unless something is significantly better, why would we even bother, right? This is the SPYV, which is the value index. This is pretty good. I kind of like this. Drawdown is low. Rate of return is getting reasonably close. This is something that you could, maybe keep an eye on. Again, if it's not significantly better, why bother? But it's interesting to note the difference between value here and growth here. The SPY-G is the growth ETF. Naturally, the rate of return is higher, but the drawdowns are also higher. And for me personally, I'm a risk manager, so I look for the low drawdown first, and then I look for the increased rate of return second. So none of these are really hitting so far. SPHB is the high beta. So these are going to be stocks that move more than average. So when the S&P 500 moves, some stocks will move more in both directions. These are the ones that are highlighted there. Good performance, but again, high beta stocks is not really in the spirit of what I'm trying to do with this strategy. I'm trying to keep drawdowns to a minimum, and why would I be chasing the high beta stocks? RSP, This is the equal weighted S&P 500 index. So for anybody who doesn't know, the S&P 500 is essentially weighted based on the larger companies have larger weightings. Currently, NVIDIA is the largest S&P 500 company. But if you're talking about an equal weighted index, then everything is pretty much weighted equally. And obviously, that's not going to be very good recently, certainly in the last 10 years, because it is those NVIDIAs and Apple and Microsoft. Those are the ones that are performing the best. So when you equal weight them, of course, we are expecting some underperformance. So far, not a whole lot of thrilling stuff to look at. VXUS, this is interesting. This is basically an international fund, X the US. So a really good fund, Vanguard fund, minus the US indexes. Now, this is interesting to me because I don't actually hate the idea of finding somewhere to put some international exposure in. The problem is the S&P 500 has for many years clearly been an outperformer. And we can see that recently international stocks have started to do better, but it's still not quite at the point where I would say it's time to substitute something in. Same thing here, the IEFA. This is again another good international fund. It's done reasonably well recently, but performance-wise, I don't know. It's just hard to include emerging market stuff when, the US markets have been for many years, multiple decades, the top performers. So that's why the S&P 500. Now, individual stocks get interesting. I don't think it's going to surprise anybody that if you start using NVIDIA or Apple or Amazon, Microsoft, you're going to start to get better numbers as far as rate of return goes. But what you will also get is massive drawdowns, obviously. And I suspect, given the extreme valuations of some of these companies, when the market crashes, it's going to be pretty punishing. And you might say, well, that doesn't matter because we're supposed to be exiting this aggressive and into safety anyway. However, the thresholds between these positions, it's not always clean. I don't have a crystal ball. We get it right the vast majority of the time, but there are times when you just get the signals timing a little bit wrong. And so if you're using an individual stock that can have really, really ugly single days, you wouldn't want to get caught in something unless it's just clearly going to be way better. And, given the fact that our defensive rotation and tactical, they already perform really well, I don't think we need to be chasing this at the risk of perhaps getting the timing wrong. And then you've got things like safety, right? So Walmart, Costco, Johnson & Johnson, Coca-Cola, these types of stocks, not surprisingly, they're going to be worse than the S&P 500. But in many cases, in fact, in all except Coca-Cola, the drawdown is larger as well. So definitely not worth using individual stocks. That's a question I get all the time. Hey, why don't we just substitute NVIDIA in? It's the best thing. Well, not really. The only really interesting one to me, and there was actually a time very briefly when we used Berkshire Hathaway. And you can see here, performance-wise, it's basically the same. It gets there slightly differently, but it's been a very, very good performer as well. And I do personally love the idea of them having, $350 billion of cash right now on the sidelines. But the problem with Berkshire, and this is, not to sound too grim, but with, the loss of Munger and Warren Buffett's, I think he's 95 years old. A lot of the team is probably at the tail end of their career. It's really difficult to know what's going to, how well the performance is going to translate through the years. But like I said, with a cash pile that large, it wouldn't be the end of the world to revisit Berkshire after the market crashes, because they're going to have so much cash to go in there and buy things at really good discounted prices. So it is definitely possible that coming out the other side of a market crash, Berkshire might be positioned quite well if they, make the right purchases and whatnot. Like I said, it won't be the original team, but that is an awful lot of money to be able to jump into a crashed market and scoop up all the deals. And then, of course, we've got all of these. I'm going to save these for a separate segment. These are the individual ETFs the sector ETFs for the S&P 500. Some of them perform terribly. Some of them perform really well. A couple of them are quite interesting, but I think it's better to just do them all at the same time. But essentially, going through all of that, and I know a lot of you watching this are kind of checking the boxes of the questions you've asked me over the years. Hey, what about this one and that one? We really have not found any replacement that is better than the S&P 500. just straight up SPY. It does exactly what I want it to do, manages drawdowns really well. It's got a really good place in the aggressive position where if you do get caught in a really bad, just missed signal timing, you don't get crushed by it, which is nice because, of course, like I said, no crystal ball here. It's just tactical rotation based on volatility metrics, trying to get it right 80 to 90% of the time, and essentially really trying to time the next market crash. The major market crash is when we're really going to accelerate here. But so far, basically that sums it up. For this strategy, there's really nothing better than just vanilla S&P 500. So there you go. Hopefully I answered a bunch of people's questions. Let's just glance before we do the next segment on Bitcoin. You should add a new category, Twitter strategies, where you actually backtest and show the results of 2% of portfolio, short UVIX. I'll get to that one. That sounds like a reasonably interesting question there, but let's get into the next segment. Okay, firing up the next segment there. That's why I do those little intros, to give myself 10 seconds to kind of close everything. But okay, well, we've got to talk about Bitcoin. But the more overarching premise of what I'm going to be discussing here is something that I see an awful lot. And it's a huge mistake that investors make, where they look at a chart of something. And in this case, we are going to be using Bitcoin and MicroStrategy. They will look at the chart, and it starts here, and it ends much higher. And they will use that to tell themselves, well, this is a really good investment, right? Obviously, I should be buying this because if I would have bought it on that date and I would have held it, I would have made all this money. This is not actually a good way to determine your investments, because all that matters is what you make when you're holding the investment. If you get into that trap of looking backwards to all the years previous, something like Bitcoin is going to get you in trouble because, of course, the rate of return is over 100% a year annualized. But that doesn't really matter. Is that what it's going to make for you when you buy it now in 2026 going forward? Probably not. So there's actually something quite interesting that we can look at. Of course, we are going to be talking about Bitcoin. It's down 50%. Now, this was done pre-market. So today is actually a big recovery day. I know some people are going to be like, oh, it's only down 43 or whatever it is. I know that crypto's recovering a little bit today, but everything basically still applies. But what we're essentially going to be focusing in on is MicroStrategy. It is, again, pre-market. It was looking like it was up a ton. I think it's up over 20% or something stupid like that. But at the end of it, I hope to make a general point that it is still no safer today than it ever was. But MicroStrategy being down 80%, the point that I want to make here, and I don't know if people actually know this, but MicroStrategy started buying Bitcoin in August of 2020. And it wasn't a small amount either. They purchased 21,400 Bitcoins at a price of 11,600. So right off the bat, when people hear that, I would imagine you're running the numbers in your head thinking, man, I mean, Saylor, he's a genius trader, right? He saw this early on and he started buying in 2020. So he's made a fortune. Anybody who's listened to this guy and followed his trades are clearly millionaires, right? I mean, 5 years, Bitcoin has gone up an awful lot, as we're going to see. So currently right now, he has 713,000 Bitcoins. Pretty heavy. And for a guy who started buying 5-6 years ago, heavy buying, not just light, he should be up a fortune, right? Well, Bitcoin itself, since Michael Saylor started purchasing, is up 443% since August of 2020, right? So pretty good, right? Obviously some big drawdowns. It would not have been a smooth experience along the way, but it's up 443%. This might surprise people, but Michael Saylor himself and MicroStrategy themselves on their Bitcoin holdings are down 17%. Now, again, today, some recovery, but still, when you look at the chart, like I said, you might be tempted to look at something and go, wow, Michael Saylor's a genius. MicroStrategy is the greatest company in the world because he started buying it here and now it's up 800%. That might be the basis for your investment. And you might get trapped by a very common thing that happens in the financial industry, where you have to remember that these genius traders, the Michael Saylors of the world, the Cathie Woods of the world, they don't get famous until the curve starts going up. That's when everybody piles into their trades and thinks they're a genius. And what happens? They crater all of the money, and they end up at a place where they're actually down money despite the underlying being pretty good. So essentially, you can run the numbers on what's called their dollar-weighted average return. And the average investor, you might think, oh, wow, they've made a fortune. The average Microstrategy investor is down about 12 to 18% as an investor of Microstrategy. So again, it's one of those things, and this is the ARK Innovation ETF. Same thing happens here where, one good year with Tesla turns her into a rock star, but she basically lit $20 billion of investor money on fire. And everybody who followed her, the average cost basis of anybody who listened to this so-called genius trader that's all over CNBC and all over the news, I mean, arguably the worst investor on the planet, and the only person that might actually be worse is this guy, right? And the only reason that I say that is because, I recently tweeted out, I'll read this for anybody who's just listening. I said, too early to remind people that Michael Saylor, Microstrategy, had one of the largest financial losses in history in the dot-com bust. I'm sure it was totally innocent, but he had to report massive adjustments due to aggressive accounting practices. Just saying. Basically, what I'm getting at here is the SEC actually charged Saylor with fraud, right? And he lost, I think, $6-7 billion in a single day, but he also basically cratered his company because he was a fraud. And for 20 years, he was probably looking and eyeing for the next thing. And he found it right there, starts buying Bitcoin. And wouldn't you know it, it actually starts doing well. And he's all over the news. And everybody thinks this guy's an absolute genius. But unfortunately, the average investor that followed him is still negative. And this is kind of what I'm talking about with, you have to be careful looking at charts that give the impression that you're looking at something that you're actually not. Same thing, I did a live stream on the ARK Innovation ETF long before it started crashing, and it's just saying, just avoid it. This is a person who has no timing whatsoever, no stock picking ability. It's basically what Michael Saylor is doing. He's basically just doing this and buying Bitcoin and saying that that's a good way to make money. Clearly not, because you bought it in 2020 and you're still down money. So obviously investing requires a little bit more than just doing this and buying. And Cathie Wood with the ARK Innovation, it requires a little bit more than just organizing ETFs as far as, oh, that's a disruptor. Let's just shove that into the portfolio. Well, how does that work out, right? Obviously not good. When you're dealing with people that are clearly clueless in what they're doing, they're incredible good at marketing. That's what you're looking at when you look at this, these types of funds. And to bring it back to the short vol trade, I see this all the time in the space of short volatility as well, where people will make it very clear on Twitter that they are a short volatility trader. Oh, I'm a guy who shorts the UVXY, for example. And then they'll constantly fire a chart that looks like this. And what basically the connection they want people to see is, well, if this guy's a short vol trader and this thing was here and now it's here, clearly this guy's a genius. He's made a fortune. Well, the truth is, no, that is not how it works, because it's the risk management that gets people. You could easily be a short UVXY trader and have lost a lot of money on this chart. It doesn't look like it to people when they look at it initially. They think, how is it even possible that you could have lost money? Well, they all do, right? We've seen the studies and statistics, and there's no wonder nobody ever shows their actual performance. They just keep showing this chart, right? Well, it's kind of the same thing as this. Anytime you say anything questionable about Michael Saylor or Bitcoin, first thing people say is, well, look at the chart. They're geniuses. They've made all that money. They're mega millionaires. Nope. Sorry. If you run the numbers, the average investor who followed them is down a lot of money. And that's just how it happens, where people only get famous once they've reached their limit and it starts to become apparent that they're not really the genius they have been representing. So my general point on MicroStrategy is As most people know, I've made it quite clear that I think Bitcoin's days are numbered. I think it's probably got another run up to go. But, I've always been saying 2-3 years from now, I think that, governments don't like competitors to their own currency. So, of course, it's at some point, once they gather enough data from the crypto world, they're going to start squashing in any way they can and start launching their own digital currencies, probably fire off some type of stimmy check to get everybody on the US digital currency coin. Here's $1,000 stimmy, but under the condition that you sign up for the government website. And then they get everybody in the system. And then at that point, they just kind of shut down all the competitors. So that's my stance. But I do think it has another recovery coming. I'm not saying Bitcoin's going to zero yet. I'm just saying that as it goes higher, I do suspect there's a lot of people out there that are waiting for just one more. Just please get back to 100K. And as soon as it does, I really don't think it's going to get to 125,000 like it was before. I've basically, put my statement on the line. I'm calling it. Bitcoin never sees an all-time high again. But I do think it'll have another run up. There's going to be a lot of big wallet holders that have some power still, and they're going to make one more last run. However, this is not investment advice. This is just my personal opinion. I would stay away from Microstrategy. He is clearly a charlatan in my mind. He is already a charged by the SEC fraudster. And for 20 years, he made nothing. And now he's done this Bitcoin thing. And for the last 5 years, he's actually down money still, which is just mind-blowing, terrible timing. But it is what it is. So I would say if you're going to represent your positions on crypto, probably just stick to the Bitcoin itself. That's what I would personally do. I think the IBIT works great. I would absolutely stay away from anything that looks like this when your actual profit is negative. Like I said, just world-class terrible timing. You would have to get out a spreadsheet and literally focus on crunching numbers to do worse. It blows my mind that people actually look at these investors. And, Cathie would always catch strays on my live stream, but her the same thing. Like you'd literally have to get a strong pot of coffee going and a full-on spreadsheet with a Microsoft optimizer going to try to underperform her. Like it would just be really, really difficult to do worse. But non-stop segments on TV and Kramer and whatever, it is what it is. But Bitcoin itself, maybe another run up, probably not to all-time highs. I think there's a lot of people with one foot out the door. Kind of the writing is on the wall here, but could be wrong. Maybe it goes to, what is Cathie Wood saying, 10 million? Yeah, let's trust her. She's got a great track record. All right, that's enough. Let's get to the open Q&A. Okay, hello, 3-year subscriber. Welcome. Yep, you're strong supporter. You very regularly pop in for a couple of questions, so appreciate it. You should add a new category, Twitter strategies, where you actually backtest and show the results of 2% of portfolio short UVIX or pair short SVIX and VXX, etc. So the second part, the pairs trading, that gets pretty interesting because there are actually some things you can do. The one thing that a lot of people forget, though, when they're talking about these pairs trading strategies is what they're looking for is profit. And when you're doing these things, when you're pitting two things against each other, profit can be found. But that's not actually what you're looking for. What you're actually looking for is this the most efficient use of the capital that is required? So if you did something like an SVIX VXX or incorporating the front futures and the midterm futures in some type of pairs trade, you can make those profitable, even when you back out the fees. That's one thing that catches a lot of people is the fees can be insane. And of course, if you're shorting, you can get your shares called away. It's not nearly as clean as you'll make in a spreadsheet. But the point is you can actually make them look profitable. But that's not the question. The question is, that's very, very capital intensive. Could I just take that capital and do something better with the money? And almost always the answer is yes. So pairs trading is actually very easy to make it look on a spreadsheet that it would work. But it's actually very difficult in the real world to make them the best way to allocate that chunk of capital. As far as the short UVIX, I know that the UVXY itself has had a drawdown of 1,500%. So the UVIX is what? going to be in the 2,300% range. So if you short 2% of the UVIX and it spikes up 2,300%, that was during COVID. Remember, the governments threw trillions of dollars to make it stop crashing. It didn't have to stop at 2,300 down, or in this case up, but you're short. It didn't have to stop at 2,300. It could go to 3,000, 4,000. So you could literally be in a situation where you put 2% of your portfolio in short UVIX and think, well, this is great, I'm just going to leave it there. And you could lose like most or all of your entire portfolio. That could literally happen. And the other problem, of course, is let's say you don't blow up. Let's say we don't see a 4,000 spike. We only see 2,000 and you survive it and you keep going. What's the best case scenario? I mean, why would you even bother, right? You put 2% of your portfolio at risk. So what if you're right? What are you going to make 3? You're risking 50% of your portfolio to make what? Double your money on a 2% allocation? It doesn't make any sense. What I always tell people is the goal of investing is not to make money. I know that sounds really weird, but let me kind of fill in the gaps there. The goal is not to make money. There's a lot of things that make a positive profit. The goal is to use your capital as efficiently as you can and put the maximum amount of money into the market that you can and make the most possible. That's your goal when you're an investor. So I'm not saying that a buy and hold short UVIX in some tiny amount couldn't be somewhat manageable. Maybe it is, and maybe it even makes money. But I can put 33% of my capital in something like the tactical volatility strategy because the risk is very low. So I don't have to worry about losing 50% of my portfolio on a 2% allocation. I can just allocate a very large amount of money to strategies that have a long history of success and don't put everything else that I do, because I'm also an option trader. I also have plenty of stuff going on in my portfolio. I don't want to put that at risk because I'm a UVIX trader. That's insane. Why? Like, let's say you have a side portion of dividend stocks. You're really going to put your dividend portfolio at risk because you want to play around with leveraged short vol? That's what's going to happen. When it goes badly, your dividend portfolio is also doing poorly, presumably, right? And then this one accelerates so much that it overtakes half your portfolio. Why, right? Why? Is that the most efficient use of capital? Obviously no, right? So again, this is not me saying this can't work, this will be negative. Maybe it's positive, but it's not positive to the point where you would waste any time or capital allocation on something like this. So hopefully that made some sense that, like I said, it sounds weird when I say the goal of investing isn't to make money. There's 1,000 different strategies that can make money. Our goal is to find the best 10 that make the most money with the least amount of risk. That's what makes a good investor. A good investor doesn't say, hey, I could do this and this and that and pit this against that, and this is short and this is long and this is a triple leverage and that one's, and boom, there's profit. Who cares? Profit's easy. Profit that's worth it with a manageable drawdown, that's the goal. That's the holy grail of investing. What about 2x SPY? We will get into a separate one because I think there's a lot to unpack there. But like I said, this is a sort of a planned course, and I certainly have at some point here probably talked about, this one. SPY versus SSO versus UPRO. I'd probably use the SPXL just because it's been around a little bit longer. But yeah, single, double, triple leverage, that's coming. It's a very interesting conversation that certainly is going to require, the full 5 minutes to unpack. So I'm going to do one there. Bitcoin is dead. Oh, okay. We've got somebody who doesn't like me. I always like these because I don't get any haters. I've been doing, social media for well over a decade, and I just don't get any haters. I'm not that controversial. So when I get them, it actually, I wish I had a few more haters because it juices the algorithm. Algorithms don't like when a person is either just totally boring or totally wrong. Like, you kind of need some people to think you're a genius and some people to think you're like this guy, an idiot. Let's see if he's talking about me. Maybe he's talking about Saylor. Bitcoin is dead. The title, I'll own up to that. That's a little bit clickbait, but it's YouTube. What are you going to do? If I had $1 for every time I survived its death. Well, I mean, come back in 5 years and tell me if I'm still an idiot, right? I mean, I am only a guy who does the analysis and puts my opinions online for everybody to see. And I've got a, not for nothing, a very large investing community that's following my portfolio. And I put it all on the line. So do you do the same? Or is this the only public comment that we can ever gauge like, what are you saying? Why don't you put your opinions later on in the chat, and we'll have a conversation about, what you think about Bitcoin. I'm always open to new evidence, right? I can always change my opinion. Bitcoin so far has been trading in 4-year cycles. It's easy to bash Saylor right now, but situation might be very different in a few years' time. Again, very, very dangerous way to look at the investing world when you allow people to be bumbling fools, clearly the worst market timer with no strategy whatsoever, just blind dumbass buying no matter what. When you allow people to do that and you justify it like, don't worry, just wait for the future. I don't want to call you a cult member, but that's kind of what it sounds like when people do that. You can't excuse performance that bad. You can't excuse mistiming to where the underlying asset is down 50 and you're down 82. You just can't excuse that. Cathie Wood is so far underperforming the market, it's laughable. But there's still people who watch her on CNBC and be like, yeah, no, you'll see. Just wait, you'll see. We can't excuse this type of underperformance. So I'm not saying you're wrong. It is certainly possible we could come back in 3 years, and I was just wrong. Microstrategy does recover back above its all-time high of 543. It recovers above that. Great. But that still doesn't mean he didn't have the 80% drawdown and you couldn't have done better on your own. Of course you could. A blind monkey could throw darts at the S&P and beat this. This is insane underperformance. So we can't be the type of people that justify it simply because we have a prediction of the future that if you're right, it will fix everything. It doesn't fix everything. Investing is an emotional endeavor. And when you're down this much money, why do you think the stock is down this much? It's because people are pulling the plug left, right, and center. That's what's happening. People are capitulating and panic selling. That's why the price is doing what it's doing. So you might be on this team, but the vast majority of other people are like, this is insane. I've never seen a charlatan like this. I'm out. So the emotions of a drawdown cannot be undone if you happen to eventually be right. That doesn't fix the problem. So unfortunately, his track record is already just full on, full stop, ignore from this point forward. Doesn't matter. The damage is already done, even if it recovers in the future. If I have an 80% drawdown in my portfolio, I will not be on a live stream saying, guys, don't worry, we'll get it back in 5 years. What would you say to me if I did that? If I had an 80% drawdown and I, with a straight face, came on a live stream and said, guys, come on, this is all part of the plan. Just wait 5 years. I'll get all your money back and more. And not only more, it's going to go to $1 million. How would you feel if I can make you a millionaire? Like Saylor, guys, the entire comment section would be screaming at me. Well, actually, it would get one viewer because I'd already be, just ostracized from the industry. But, Michael Saylor is, if nothing else, a genius marketer. Even SEC charging him with fraud and having arguably the single worst financial loss in history and no recovery of performance for 20 years after that, that wasn't enough for people to look at it and go, what will? I don't know. MicroStrategy is just a leverage play on Bitcoin. I would like to say that's true, but it's not true, because if that was true, it would be tracking the price of Bitcoin. But it's actually an independent investment that has massively decoupled from Bitcoin. It did way worse or way better for a while, right? So it's not just leveraged Bitcoin. He's been doing the whole Bitcoin and he has 713,000 Bitcoins now. He's still down money, but it actually is decoupled from Bitcoin, and that's the problem. You are not trusting Bitcoin itself. That's why I said if you're going to play the crypto game, I would totally just stick with Bitcoin, right? Just kind of like when I went through the process of trying to find a replacement for the S&P. Do I want to trust some individual fund manager who has a formula for the best 100 momentum stocks that I will never know? Or do I just want to trade the S&P? I mean, clearly the S&P performance is better, and I don't have to trust this, this team of fund managers who I don't really know what they're doing behind the scenes. Why would you do that? Saylor sucks. His timing is terrible. Anybody could do better than him. He's just exceptionally good at raising capital and speaking on camera to the point where people actually believe him. He's way better than, I'm a newborn baby in the marketing world compared to Saylor. But as far as an investor, it's disqualifying to be this bad. It doesn't even make sense how he could be so terrible. But of course, you can trust it. It's fine. I would not put Saylor and Wood in the same basket. True, I am not aware of Cathie Wood being charged with fraud yet. But so it's probably unfair to Cathie Wood for me to put Saylor in the same basket, because Saylor quite literally was a fraudster, whereas Cathie Wood is just the world's worst allocator. In the US, taking a loss and rebuying creates a wash sale. Should we look for alternative ETFs to buy back in the 30-day window, or just push for the loss forward until December and then stay out for 30 days? So correct, right? Investing has rules, and everybody has to follow the rules of their country and their jurisdiction. But also in the US, I don't talk about taxes because I'm not a tax expert. I don't talk about things like, wash sales and whatnot. But perhaps the large language models can help with that. There are certainly ways that you can either just straight up avoid the wash sale rules, or, like you said, little certain things you can do. Using options is sometimes a good idea. These are just ideas throwing out there, but I am not an expert, and I really, we've got members from 70 countries. I can't possibly know all the regulations from all these countries. So I just always encourage people to, if you need to, just hire a fee-based advisor for an hour or two, just somebody who is in your jurisdiction, in your country, and just have a list ready to go so you don't waste any time. They might charge $400 or $500 an hour, but just have a list of questions, get in there, get focused. Don't talk about golf or fishing or your family. Just go straight in there. Question 1, let's deal with wash sales. Question 2, what ETFs have, implications with my strategy and my fund, and get it done so you just understand your own country. That's what I would say. But if you're unaware of it, it could be a small problem at tax season where you have to account for everything, but there's also ways to deal with it. And unfortunately, I kind of have to punt because I don't speak about things I'm not an expert in. Saylor is not a trader. He never said he was trying to time his buys. Well, then don't time your buys and stick with Bitcoin. Why would, again, I'm not trying to hack on the question. These are fun to talk about, right? I'm having a great time talking about Saylor and Bitcoin. But the truth is, there are ways to make excuses for people. Again, if I came on a live stream after suffering devastating losses and I said, guys, I never said I was a trader, right? I never said I was trying to time the market. What would you say to me? It would be an insane thing to escape my mouth. But for some reason, when Saylor does it, it's justified. It's fine. No, he's not a trader. He never said that. He's just blindly buying. Okay, if you're going to blindly buy, then at the start of every single public appearance, say that. Tell everybody how bad you suck. Tell everybody you have no idea how to buy or sell or the timing of anything. Tell everybody you have no strategy. There's no rhyme or reason to any of this. I am literally just closing my eyes and buying. And then start talking. Okay, I'm fine with that. Full disclosure, no idea what he's doing. Great. Then see if you can get invited on CNBC. But he tries to dance on this middle line where he tries to pretend like he understands Bitcoin better than anyone on earth. And yet the record shows something polar opposite to that. So I don't mind if you stick to Saylor and stick to Microstrategy, just understand what you're doing. You are looking for justifications when, in my personal opinion, there are none. There is no justification for somebody who's that bad at their stated job and their stated goal. I hope his goal is to make money. If I'm wrong about that, well, then I'm wrong. But I think he's trying to make money. And I can see mathematically he hasn't. So this is a problem. And again, nobody would cut me slack if I was doing the same thing. If I was charging money for a subscription that's down 80%, and I said, guys, I never said I was a trader. How bad would you laugh at me? I mean, it would just be insane. It would be insane, wouldn't it? Saylor isn't trading. He just accumulates as much as possible. So just accumulate it yourself. It's like the financial industry. You could pay some guy 1-2% of your assets every single year to buy some dumb buy and hold pie chart of things that you could allocate by yourself on your own for free. Sure, go ahead. Find an allocator and pay them an exorbitant amount of fees for that. Cool, but you could just do this yourself, right? You could also just accumulate, and perhaps you have an eye on timing of some kind where you wouldn't have entered in 2020 and in 2026 you're still negative. Like perhaps you could have done a lot better. Maybe you're giving him too much credit. Maybe you're way better than this guy, and maybe you should just say, hey, I'm sticking to being the allocator of Bitcoin myself. I think I can do better than this clown. I would certainly say the same thing about Cathie Wood. I would certainly say, well, I'm not buying anything she touches. I can absolutely do better on my own. Why would I pay her the fees and give her a mansion on, Central Park in New York? Why would I do that? I would just do it myself. Do you see any alternatives to systematically trading Bitcoin, a crypto that does not have derivatives? Well, as you know, I've been trying to actively trade Bitcoin with, roughly 5% of my portfolio. And it's tough because crypto doesn't really have any consistent correlations to anything else in the market. There are times when it's correlated to the NASDAQ, right? Most of the time. But as we've seen in the last 4 months, that is totally not what we've seen in the last 4 months. If you look at a chart from 2021 to 2025, it is very correlated to the NASDAQ. And so my main strategy is based on that correlation, and it has completely broken down. So yeah, it's rough to trade. Now, I still think every single person in the chat could do better than Michael Saylor, but that is not, you do with your own money what you want. What about Tom Lee and his thoughts on Bitcoin and Ethereum? I mean, he's obviously completely wrong all the time, but the thing about these types of people, the Cathie Woods, the Michael Saylors, the Tom Lees, it's the exorbitant predictions that is intoxicating for people, because it's very difficult to make money in this world, and becoming more so every year. There's more and more people who are living paycheck to paycheck. There's more and more people who are financially scared of the future. We used to live in it, like I'm old, I'm in my 50s, so I still remember a time when you actually could just go get what's considered a kind of decent run-of-the-mill job, and you didn't feel this dread like hovering over you. But certainly the youth now, but I'm in my 50s, I'm reasonably successful, and I have financial dread. Like I'm worried about what's going to happen with AI and what's going to happen with the job market, and I still feel it, and I'm way past that point of being terrified of it. So I think that's one of the keys, is that these people, they make such exorbitant claims that people in their head like, wait a second, Cathie Wood's not saying that Bitcoin's going to go to 200,000. It's going to go to 10 million. Tom Lee is not saying Bitcoin's going to go up. If it does real well, it's going to double in 2 years, which would be insane. Doubling your money in 2 years is crazy good performance. He doesn't say that. He says it's going to triple in a month. Like stuff like that there's just a very small percentage of the population that believes these people. They're charlatans for a reason. There's 8 billion people in the world. You don't need to convince that many. You just need to get 1% of the most financially vulnerable people to start getting their calculator and figuring out how much they're going to make if their 0.25 Bitcoins goes to $10 million. That's going to solve all their financial problems. And so they're in, right? She didn't say it's going to go to 150K. She'll say it's 10 million. Tom Lee will say it's going to happen next month. Quick, buy, get your credit card. They're not talking to me. right? That's why I'm doing this live stream. I see the environment and I have better options. I don't need these people. They're not talking to me. Tom Lee is not out there trying to convince me of his opinions. He's trying to convince the emotionally vulnerable to just do something stupid because what the hell, it might get you out of trouble. That's what a large percentage of this is. So if you're a person who has fallen for the Michael Saylor and you've drank the Kool-Aid and you're one of those, is it possible, and I'm not saying this is true across the board, but is it possible that some of that is coming from the fact that you're feeling like maybe you didn't save enough, maybe your income isn't high enough, maybe you are, like me, kind of worried about the future and the job market and whatnot. Some of it has to do with that. Again, Tom Lee, it just bounces right off me. I just think like, oh, what stupid thing did he say today? But I don't mean to belittle it, because there are a lot of people who are legitimately looking for answers to fix this broken world that we live in, where 60% of people don't save a dollar and half the population has a net worth less than zero. That's who he's talking to. It's the same as all these popular people, right? Andrew Tate is not popular with successful people. He's popular with people who need something to get them out of the dread that they're feeling. That's who he's targeting. He's not talking to me. I'm not joining, what is it called? Hustler School or whatever it is, Hustler University. I'm not the target audience for that. Emotionally vulnerable people are. Tom Lee will get you if you allow it. But obviously, just, how many times can you be dead wrong before people start saying, why are we listening to this guy? What is the best time to do your trade signals? Market close or after the email is sent? I know it might not make difference long term, but just because I'm curious. It is a very good question, and it can make differences, big differences, short term. But you're right, long term, it should all average out. Like for me personally, our track record is based on the live trade fill prices from this account, right? I put enough money in this account that I can track all the trades, but there's not enough money that if somebody happens to hack me, because I'm kind of a tech illiterate person, that I wouldn't, I'm not saying I'd be happy to lose, 141,000, but it wouldn't be the end of the world, right? So it's coming from live trades within about an hour or two of the email. But if you wait till the end of the day, it's still the same active signal. It's fine. If you're busy, you've got hobbies or a family, or you're working and you can't get to your computer, you can do close to the end of the day. It's fine. Some days it'll be worse. Some days it'll be better. And the longer you go, the more it will mirror what we're doing, what everybody in the community is doing. But short term, you've seen, how many times have you looked at the market and you saw, it cratered 5% on the QLD or the SVXY into the close, or recovered 5-10% from the lows. It happens, right? So there are times when you think, God, I did that wrong. I should have traded at noon instead of 4. You can't play that game. The market is a random walk. I have no idea. Like whatever the market's at right now, up 1.5%, I have no idea whether it's going to close negative or not. I just don't know. None of us do. But I do know that my signals are active for that day. So whenever you can take them, take them. I'm also going to start sort of having that available for people to look at, so that they can maybe account for some of the differences, and been talking about that with a couple people. So unfortunately, intraday noise is a emotional struggle for some people. For me, I just take the trades in the moment and I just don't give it a second thought. But yeah, if you do. Thoughts on Robinhood and an investing platform? Any recommendations? So I've never used Robinhood. I've never had an account there. So I can't really speak on it. I use Thinkorswim and Interactive Brokers, and that's all I've ever used. I've never used Tasty. I've never used anything. Never used Fidelity. Nothing. So that's it. Some people like it, I suppose. I think people talk about it's relatively easy to use, maybe cheap and whatnot. But I would just say go for the big ones. Go for the ones with the best customer service. Go for the, is there something wrong? It doesn't take very long to move capital between them. So TOS/Schwab, right, being the one that I use. Interactive Broker is the other one I use. I can recommend both of them. They're great. And Tasty, I've just heard nothing but good things about. So between those three, I don't think you'd have to go anywhere else. Okay. I don't think Saylor is a fraud. Yes, he was accused of not paying taxes once. Well, whatever you're trying to justify, he did lose $6 billion that day when he tried to, do a creative adjustment on the, so to try to say that it's something like, oh no, this only affected Saylor personally. No, he's largely credited with having one of the largest financial losses in history. He's the guy. So whatever reason you are going to assign to that, like I said, let's get this chart going. This is not great. Like whatever you're going to say happened on this day, and it's nothing to worry about. The SEC charged him with fraud, and he was accused of aggressive accounting practices. Okay, well, whatever you're going to say, you can see the drawdown, right? Like you can see that this, roughly $180 down to 42 cents. This isn't great. I would say that this is probably something you'd want to steer clear of, just personally. And then to still have not made any money 20 years later, again, I'd probably steer clear of that. And then I'd probably steer clear of somebody who underperformed the underlying asset by 420%. I'd probably steer clear of that. I'd probably steer clear of all these people. Like, you don't have to. I didn't do this live stream. It's just chart blitz. It's just fun to look at these things. I'm not telling you can't do it. If you trust this guy, boy, you go for it, and I really hope that it's not a big mistake. But I just think that every single person on planet Earth could do better if they just did it by themselves or sought out better advice, right? When you're looking to go long volatility, what specifically are you watching in the VIX term structure to tell you of true regime change and not just temporary backwardation? For long volatility, it doesn't get there easily. And what we are essentially looking at is what I would call a full breakdown, right? So I don't have the percentages here. It's a different chart. But the VXZ long volatility, this is only about 2.65% of trading days. So we are looking for basically clear signs that it is a full collapse. Otherwise, we're just in safety gold, right? We're in gold today, for example. We're not in long volatility because what happened yesterday and the day before, sure, it kicked us out into our safety position, but it's not nearly, red alert yet to go long volatility. So essentially, the volatility barometer is going to tell us when it is that full-on red alert, and then we get into long volatility. And you're hoping for some follow-through. It's not going to happen when the S&P is down 2%. It's going to be down 4, 5, 7%. And then you get into the long vol, and sometimes it reverses and you lose money for a day. What we're trying to do is get that follow through where, of course, there's going to be a major crash at some point. .com bust. If you would have shorted Saylor, you would have been a billionaire. But that happened. The financial crisis happened. The COVID happens. There are opportunities, but you're never going to get it like at the peak, right? So I'm the type of person that I'm not a contrarian investor. I try to follow what the volatility metrics are telling me today, right? I'm not trying to say, well, I'm going to go long vol because I think the market's going to crash in 2 weeks. I need more evidence than that. I'm a quant-based, evidence-based trader. And in order to get to the long vol range, we need significant breakdown of the market. You are terrible. Lol. I hope you're being facetious. I'm not actually terrible, but I am calling out a couple of the world's most terrible traders. Here's one, wise words. Thank you. ORR has been mentioned before. Yes, it is. It's on the list. Like I said, once we get to the somewhat more interesting ones, right? I personally think the safety position is slightly more interesting. And then when we get to these two, that's going to be the interesting stuff. And so if you have some suggestions, of course, shout them out. And probably I'll get to that one next week. That should be interesting. Could you please show which formula You used to calculate back SVXY in your Excel with the underlying index. No, I'm not getting into that anymore. I've done that before. God, it must have been, I don't know, I want to say 2014, 15. Yeah, I don't want to get into that. It's a long process of reading the prospectus and figuring out exactly how they calculate it. You can get, like, it's not overly difficult, but to get it exactly, it was a nightmare. And yeah, you've got some fees to take care of and some treasury holdings, and it's just not fun. So at this point, just download it from me. Trust me, you don't want to do it yourself. I don't ever want to do it myself. There are ETFs that you could do it on that I don't have the data going back to March 26, 2004, and I don't care. I don't want to do that again. So there are some that I just leave it where it is. Yeah, just download it from me. There's a free spreadsheet download at VTS. Thoughts on investing on foreign markets? Well, that's like I talked about in the presentation. It does sound like a good idea, and I'm somewhat intrigued by the idea of having at least some international exposure. The problem is the performance just isn't there, no matter how much I want it to be. And it's decent recently, so I will certainly keep an eye on it. But, a couple years of decent performance, I don't know. I'm not super confident on all the economic decisions that are being made in the US, so perhaps. But for now, nah. Funny thing is, Microsoft can go bankrupt and his company owns the Bitcoin, not the shareholder. If you want Bitcoin, just buy it or don't. I agree with that completely, that I'm not saying don't buy anything, but I am saying it would be more wise to take the variability of individuals out of your investing thesis on crypto, because nobody really knows what's going on. And even the guy who's credited as, I think if you were to do a poll, just go out onto the street and find 100 random people and ask them who's the most knowledgeable Bitcoin person in the world, probably Michael Saylor would win that poll. And he is quite clearly not, right? Quite clearly not. So yeah, I would just take the variability out of it and just buy the Bitcoin yourself. I don't exactly know what happens in the event that, say, Bitcoin drops to 40, 30, 20,000. I don't know. I mean, it's such a convoluted thing now. When it started out originally, you could kind of understand it. It was fairly vanilla. You've got the counterparty with the debt and the preferreds, but now he's got just a whole suite of them. There's other people doing the same strategies. It's just the whole market is a mess with this type of thing. And yeah, I would just steer clear of it. It's just an absolute muddy swamp of nonsense and charlatans, and the performance just isn't there. So if you like crypto, I would say Bitcoin's the safest. And if you like Bitcoin, just buy the Bitcoin, right? You can participate by just doing that. You can just take all of that uncertainty of these random people out of it. Don't listen to Tom Lee. You like Bitcoin? Figure out something that makes sense for your account size and your opinions of the future, and go with that with the Bitcoin. You don't need to tune in to Tom Lee's latest. He has nothing to offer you. Trust me. There's no wisdom coming from him. What is the status of the options strategy course and day signals? Slow but progressing. What time is it? Okay. Thoughts on the run-up in gold and silver, lasting, not lasting, technically trading it? No thoughts. I don't pretend to know what's going on. This is crazy. A lot of people don't know, but silver had another crash the second day, which was very, very interesting. I think this is a weekly chart. Let's switch this to a daily. Let's go 2 years day. Yeah, I mean, we were all so busy looking at other things that I closed out a pretty big profitable trade here during last week's live stream. That was kind of funny that it happened that way. And then nobody really noticed, but it had another major epic collapse 3 days later. So that was actually yesterday. But I don't know what's happening with gold. I really, really don't know. I mean, my guess is as good as anybody's. You could say that it might have something to do with, foreign countries trying to exit the U.S. system, the U.S. dollar, and sort of making directional moves towards the eventuality that that's going to happen. She could just say it's just technicals and just people for some reason just freaked out because Bitcoin's not doing very well. And, a bunch of other people said, well, I got an idea for, the money supply trade. Let's just go back to the good old gold. It could be some of that. It could be all kinds of things, but the price is insane. And I wouldn't say I'm worried, but where's that question? Wouldn't say I'm worried, but there's a little bit of hesitation there when you have to enter the position as a safety position, right? So we entered gold yesterday, but it's not because I have a positive opinion of gold. It's because it's a safety position. Yesterday, the markets crashed. We had to exit into our safety positions. And in this case, for the tactical volatility strategy, the safety position is gold. And so I have to use this as a safety, not as a speculation. And that's where it gets a little bit dicey when you've got something that, recently the moves. Now, fortunately today, that position's up over 3%. So I'm not complaining, obviously today. That's very, very good timing. But I don't know. I don't know. What do you think it is? I think it's probably 4 or 5 different things at work. Could also be like I said, I don't like what the Trump administration is doing with the economy at all. At all. I think this is all gonna be bad. Maybe not initially, but certainly pushing the whole world away from you as a trading partner and sort of self-isolating yourself by choice. This is not going to end well. So I don't like it. And perhaps that's what it is. It's just the rest of the world realizing that, oh, wow, on any 4-year cycle, the United States could quite literally just flip on a dime and turn on us. Like we didn't know that was a thing. But now we have to kind of plan for that. And I'm a Canadian, and you might hate our leadership, but Carney made a speech, and it was more or less the gist of it. He was like, well, we didn't really know this could happen either. Like we thought we were good trading partners. We thought we were allies. And, turns out in any 4-year cycle, the whole chessboard can just be flipped upside down. But business doesn't work that way. Like international supply chains don't work that way. You can't just flip it over and then maybe in 2029, January, some new, JD Vance is the president and he has a differing opinion than Trump does. And then he's like, no, guys, the previous guy was the one that did that. I'm not that guy. Let's take it all back to the beginning. It's kind of, the damage is done at that point, even if a more rational policy going forward was there. Like, I don't know what JD Vance, I suspect he'll probably be the next president. I don't know what his policies are going to be, but even if he tries to reverse this, I think there's a lot of trading partners kind of looking to the east thinking, well, maybe, maybe that's the horse we should be betting on. Yeah, could be. I don't know. When things go parabolic, it should freak you out. Like that's why I shorted silver. I didn't short silver because I'm a very knowledgeable silver trader. I shorted silver because nothing goes straight up parabolic forever. And I was like, this is insane. I'm putting 0.5% of my portfolio on a very strong convex short silver trade that if I'm right, I could make 4 or 5% on my portfolio. And if I'm wrong, I lose 0.5, right? And it happened to work out. But when things go parabolic, there is no reason for it. There is no explanation that makes sense. It just, yeah. Many believe that taxes are not moral. I think taxes are not only moral, but necessary. We live in a society where if your house is on fire, you would hope that the fire department comes, and they're not volunteers, right? These are people that, they have families of their own and they need a salary. And the government doesn't have a job, right? The government doesn't have a summer job. They actually need our money from taxes. So I think taxes themselves are perfectly fine. I think if a reasonable tax rate with decent, obviously bloated, bureaucratic nonsense, but reasonable management from government, so it's not just overtly insane. Like we're not expecting them to be really great with their money, but not embarrassingly bad. And then I think a lot of people would be fine with paying taxes. I would. Like I'm a Canadian. I would be fine if the Canadian government, I was actually golfing with a guy yesterday. We were talking about this. He's Canadian as well. And he also moved to Dubai. And so I live in Dubai as well. And we were talking about it. We're like, both of us love Canada. We really do. I would love to move back to Vancouver. And I probably will at some point. But for people who can move around the world and have the ability to do that, not everybody can, but for the people that can, you start to look at the world as, sort of the services they provide and who's going to treat me the best. I could live in Vancouver and I could pay 53% tax rate, not effective, but the highest tax bracket. I could pay 53% taxes and just be screaming at the government every day for how insanely bad they're managing the money. Or I could say, do better and I'll come back, right? That's kind of where I'm at now with the whole Canada thing. Yeah, I think they're fine. Taxes are required. We want roads fixed. We want telecommunications. We want to be able to use a cell phone, right? Without having, how much this would all cost without government. So yeah, I don't agree with that, but I do agree strongly that the taxes that you pay, you're not getting your money's worth. I can tell you that for sure. So maybe enough with Saylor. Yeah, I'll take it easy. I don't talk about Bitcoin very much on my streams. It's just obviously, we need to call a spade here. The guy's still negative and he's been buying for 6 years. Like, come on. Would you beat Saylor in an MMA fight? Yes, very, very easily. I'm with you on a lot of your answers regarding gold, silver, and Trump admin moves. Great. I don't mind if people are not with me. I don't mind if people completely disagree with me. I am, the only thing that I will say is my thoughts are well thought out. I don't blurt out things that I haven't thought deeply on. I don't talk about things that I haven't crunched numbers on. I don't, talk about things that I don't have data to back up what I'm saying. But if you disagree with me, I would love to see your data that points the opposite direction. But in this case, you're saying you agree with me. So great. I liked the Carney speech. So did I. I feel like the jury's still out on Carney. On the one hand, you could certainly just be as skeptical as could be, given his past and the fact that whenever we're talking about the overlord puppet master bankers, like you're talking about Carney, right? People like him. That's who we're talking about. But at the same time, I don't hate what he's doing. So, for me personally, it's a wild improvement over Trudeau. So I think I'm kind of fine with where we're at right now. And I've also I've always had the opinion that the president, the prime minister, like they're not making decisions. Carney's a smart guy, so maybe he's making some decisions. But I hate to break it to people, but Trump's not really making decisions, except with the ballroom and, where to put the gold statues. But other than that, like Trump's not determining economic policy. He's just, I view the president and the prime minister of all these countries mostly as the figurehead that is supposed to represent the country and look patriotic and look presidential. Like, be the same thing with somebody like Obama, right? Obama's not actually, like you can't possibly manage a mega $1 trillion economy when you have no background doing any of that. They don't just let the president just run in the room and start talking about things that the people that are making decisions have been working and studying in that industry for 30 years. Like the energy policy people are people who've been studying this stuff nonstop for 30 years. The economic people and the military people, like they're all making the decisions. The guy's just supposed to make speeches. So Carney made an exceptionally good speech. So he did his job. Did it better than Trudeau. And so far, fingers crossed, as a Canadian, hopefully we're moving in the right direction. Do I trade zero DTE? Yes, I do. Quite a lot. Yeah. I like it. It's fun. It's potentially quite profitable, but it's tough. It is tough. When you're dealing with zero DTE, a lot of the things that I do and a lot of things that I'm used to in the options world, duration plays a large role in that. Like putting on the right trades with the right risk management, the right levels that you're looking for, and then giving it some time to materialize. Zero DT, there really isn't a whole lot of time for that. So of course the short vol trade, it works because of the term structure. It doesn't work because I'm predicting short vol tomorrow. Like, that's not why I make money trading SVXY. It's because I'm studying the decay in the term structure and allocating accordingly. With zero DTE, there is no time. So it's just a different way of trading. Not better, not worse, just requires an entirely different mindset. I'll have some thoughts, and of course, based on my progress as a zero DTE trader over the last 2 or 3 years. Thoughts on other market indicators like fear, greed, SP oscillator, RSI, any other indicators that combine with yours. It's kind of one of those things where a lot of indicators could potentially have benefit, but it's my job to choose the 5 or 6 that have the most benefit. So I'm not saying that some of those things wouldn't have benefit. Maybe you could turn strategies and have some type of insight there. It's the same thing that I always talk about with the gamma exposure and the, dealer Vanna, they're going to do this. And then there's this many open positions, so the dealers are going to do that. And I'm not saying that it's useless. It's just not in the top 10, top 5 type thing. So I just ignore it. Maybe there's some value in those things that you're talking about. Individual, very specific, situational moments. I have to be big picture. I have to have strategies that work almost all the time, right? You can fail occasionally, but you kind of have to get it right most of the time, which is broad-based metrics that are very reliable from period to period, right? Volatility metrics, the market looks different across time, but I can tell you that the volatility metrics and the levels that I track, it hit the same levels in the flash crash and the same levels in the European debt crisis and the same levels in COVID and the Trump's tariff nonsense. They're all kind of the same thing, even though the market's doing different things. When you're talking about other indicators, RSI or MACD or things like that, the starting position matters quite a bit, right? When you're talking about moving average crossovers, well, it might work in this case, but other times you're really far away from it and the market has to crash quite a bit in order to get the crossover. So it's sort of situational in that respect. Volatility metrics that I track are kind of the same in every single market crash. So that's why I use them. I wouldn't mind paying taxes if laws and borders were enforced. Me too. Dubai has actually introduced a 9% tax already. I'm exempt until 2028, but it's the safest place in the world. And I don't mind. I really don't mind. I would pay Canadian taxes, like you said, if they're enforcing the laws and my wife could go out at night and I wouldn't be worried about her, and she, wouldn't need to come in like we were kids when the street lights come on, you have to come home. It's kind of what it's like in downtown Vancouver. I don't want her out without me. If Canadians felt like their kids were safe, like I used to walk to school by myself, a couple miles to school, uphill in 10 feet of snow, both directions, kind of one of those. But no, we walked to school and nothing ever happened. It was safe when I was growing up in the 1980s, while I was the 70s when I was walking to school. If the country functions fine, taxes would be basically a non-issue. I think if they did like a flat 30%, everybody pays. There's a hurdle, like the first 30,000 is free, and then everything above that is taxed at 30%. I don't think anybody would have a problem with that if the governments were managing things well. Can you get poutine in Dubai? If you could, I wouldn't buy it anyway. So if that means I'm no longer Canadian, fine. But I don't get the whole poutine thing. That is disgusting. That's not food. It's just not. I'm sad our meetup in Taiwan didn't pan out. I have to jump off, but thank you again, as always. I will be back in Taiwan in like a month. Or if you come to Dubai, but yeah, I'll be back in Taiwan soon. So call me. Do you have data on which product performs better for downside protection on stocks, SPY put or VIX calls? No, don't really have the data for it, but situationally, you would be looking at what the volatility on those are. Like when you're talking about buying put options buying VIX calls, buying VIX futures, buying the volatility ETPs. These are all like correlation direction-wise similar, but the different volatility levels sometimes makes one of them a really good deal in comparison to the other. So there could be times when you're buying protection and it just so happens to be a time when like the VVIX is incredibly low, right? So maybe you would want to just go straight to the VIX calls. And there might be times when the volatility ETFs are behaving a certain way where the backwardation is higher than it should be. And perhaps if you get into that, it would be an efficient, slightly more convex trade as a hedge than put options on the S&P. So it's situational. It's kind of like with all of option trading. If you want to do an iron condor on an index, okay, the SPY works, but when you're opening that trade, you should also check the Qs, check the IWM, check the other ones, check the DIA, check the MDY, just see if the implied volatility on the other ones is much more attractive for that iron condor and just go there, right? It's the same as your hedging. Once you've determined that you need hedge, then of course, specifically pop the hood on all of the available options and choose the one that's the cheapest in the moment, because they're not always the same. Directionally, they're fairly close, but this probably follows this. That's funny. That is not food. We need a better health minister that just bans it across the country. I know, blasphemous for a Canadian to say that. Taxation is theft. Anarcho-capitalism is the solution. Well, I'll use that as a keyword and go down the rabbit hole, but taxation is certainly not theft because like I said, I use a lot of the government services, and I suspect you do as well. Like when you start a business, right? I remember Obama got in a lot of trouble because he worded this very, very poorly, and it sounded like he was saying, if you started a business and you're successful, you didn't do that. You know, it sounded like he was saying that the business owner is an unsuccessful person and the government did it. What he was actually talking about, if you look at it in the full context, was that, yeah, you started a business and you're successful, but you didn't have to build your own roads. You didn't have to build your own, fund your own police force. You didn't have to build your own telecommunications network. You didn't have to build your own, healthcare system. You didn't, like, all of that is in place for you. And you just, as a business owner, you just plug into the system. And of course, you still have to be good at it to be a successful business owner. But a lot of those things, you didn't do that. You didn't pay for that. It's all there for you. And it's there because of taxes. So again, I understand the gist of it, but I think people like you are saying this because it's just such an egregious waste of government money that it brings people to this point. They're just like, well, if this is how you're going to spend it, it's all theft. It's all fraud. Like, you can't do that. Well, it's actually a middle ground, right? Reasonable tax rates are not only moral, but they are required as a functional society, because I don't know how to make this work without the government's money. I really don't know how to do that. So I need to pay a little bit into the pot so that the government builds it for me, basically. So yeah, I get what you're saying, is that they've just dropped the ball so badly that it gets people to be extreme. But anarcho-capitalism, I'll look into whatever you're trying to get at there. Maybe there's a better system. Last one. Have you ever considered a gauge for euro-dollar exchange rate? No. When to say in euros, dollars, or other currencies? Nope. I'm sure that there are ways to do that, but it just adds another variable to my trading. And I like to keep things as broad and applicable to what I specifically do as possible. So like I said, adding other metrics into my own metrics doesn't work because you get cross signals. Adding currencies and analysis of all of that, I'm going to get cross signals. It's not useful for me to do that. So I've always held my money in US dollars. That's it. I don't try to weave around the Canadian dollar or the Taiwanese dollar or whatever, wherever I'm living. US dollars, everything. Okay, so apologies to the Michael Saylor fans, but He is terrible. So there you go. Stick to Bitcoin and good luck. I really do hope it hits 125K, and I hope I'm wrong. I said, publicly, I don't think it's ever going to hit an all-time high again. I think it might get reasonably close. I think it'll crack 100 again. But God, I think there's going to be a flock of people looking for the exit if it hits 100. So we'll leave it there. No offense. Tune in next week.